The US economy is now officially shrinking. You can see here during Q1, or the first 3 months of 2025, GDP actually declined, and this is the first time this has happened since 2022. One more quarter of this means we are in an official recession, unless of course they change the rules again like they did last time about what counts as an official recession. But that brings up a good point that you and I don't actually care about whether it's an official recession or not. What we actually care about, and what most normal people care about, how is it going to impact my wallet? How is it going to impact my ability to care for those who I'm responsible for? Let's take a look. I'm Joe Brown. I'm a former stockbroker. Now I run Heresy Financial, where I teach active investors how to decrease portfolio risk and increase long-term returns. And understanding what is going on in the economy is going to give you the ability to play that better. So first, let's go back to this chart of GDP, and you can see that during Q1 of this year, the US economy shrank. The last time this happened was all the way back in 2022, which was a result of the hangover of all of the money printing from 2020 and 2021. Now, this chart is a bar graph which shows each quarter's change from the prior quarter. But to put this into a little bit better perspective, we can also just take a look at this chart, which is the cumulative value of GDP in billions of dollars. Now, this chart is real GDP, so it is adjusted for inflation. And you can see through the years, normally GDP increases. Obviously, during 2020, we had the big drop in GDP. And then after all the money printing, here's that hangover I was talking about, where in the first quarter of 2022 and the second quarter of 2022, we had a fall and then a flat line in GDP before it took off again. Fast forward to today, we now have another fall in GDP in Q1 of 2025. Now, obviously, tariffs are the biggest headlines that have been making waves for the last couple of weeks and couple of months, leading to a lot of economic uncertainty. To put the current Trump tariffs in context, historically, we can see the effective tariff rate going back all the way to the late 1700s. And while we don't know what the actual tariff implementation will end up being here over the next couple of quarters and couple of years, as it stands right now, historically, this is extremely high. We have to go all the way back to the 1800s before we see tariffs in the levels they're currently sitting at. This has created a lot of uncertainty, as we are seeing from the Global Trade Policy Uncertainty Index, even compared to Trump's first term, which is in gray here. As a result of these tariffs, expectations about inflation over the coming year are the highest they've been since 1981. And expectations about inflation over the next 5 to 10 years are at the highest they've been since 1991. In addition, optimism among small business owners has plunged, which makes sense because small businesses are not as agile and able to adapt to instant rising prices from things like tariffs, which could wipe out their entire profit margin overnight, which is one of the reasons why we've seen the stock market plummet, with the worst first 100 days of performance out of the last 3 presidents, including Trump's first term. Okay, so it's very clear there is a general sense of unease and uncertainty and a huge lack of optimism about the economy right now, and that's being projected forward into the future. But there actually is some really good silver lining here. This silver lining comes down to the main causes in the drop in GDP. Essentially, there were 2 big things that caused GDP to go negative this quarter, which was the trade deficit and the government itself. So why are these silver linings? Well, first, let's take a look at the trade deficit. You can see the last couple of months, the trade deficit has absolutely exploded. This was 100% an effort to front-run tariffs, which means one of 2 things will happen here. Either, and I'm going to talk about extremes here, obviously we could have somewhere in between, but at the extremes, either the tariffs completely go away, in which case all that front running ends up being unnecessary. All that extra supply hits the shelves, it hits inventory, and it gets made up for in the following months by a lack of trade deficit. In other words, a lack of imports, because those imports have already happened for now. Now we just have to work through them, and then we can resume business as usual. On the other end of the extreme, if we do have these tariffs go into effect, we're even higher than what we are currently anticipating. Well, then this trade deficit here that was simply just imports front-running tariffs will still be followed up by a lack of imports. In other words, over the next couple of months, no matter what happens here, this trade deficit will shrink wildly. If that doesn't make any sense, basically what's happening here is, imagine you got a notification from Walmart or Costco that your favorite brand of paper towels was going to double in price next month? Well, the rational thing to do here would be to go to the store and load up on a bunch of paper towels now while the price is still cheap. But guess what? It doesn't actually matter what happens in a month from now or in 2 months from now. You're only going to use so many paper towels, which means whether the price actually doubles or triples or doesn't change at all, you are not going to be buying more paper towels next month or the month after because you've already bought all the paper towels you need right now. You stocked up on them and now you have to work through that supply. That's exactly what you're seeing going on here with the trade deficit exploding. It's just front-running tariffs, which means all that supply has to be worked through and imports are going to drastically slow down over the coming months, no matter what. And as you can see here, right on schedule, container bookings from China to the US are rapidly declining. In fact, these are down 45% year over year, which demonstrates that all of the normal imports were just rushed and squeezed into the last couple of months, which means that on net overall over the next year or so, this is all kind of just gonna smooth out and net out against each other. Okay, but what about the second part contributing to the decline in GDP? That is government spending cuts and government layoffs. Government's contribution to GDP overall was a negative 0.25%, and it is the first time that this was a negative number since 2022. This is fantastic for one reason, and that's because anything the government does is a net detractor of overall real wealth. Whether it's a regulation, whether it's an employee, whether it's a tax, or whether it is spending, anytime the government takes any action in the economy, it is changing something to be other than what it would have been without that intervention. The way that human action works is that we all individually, subjectively choose what will be the most valuable action for us in the moment at that time, given all the available resources we have. Which means that when our behavior is forced to change through regulation or taxes or spending, or because a federal employee decides to do something, we are not able to do the thing that we value most highly. We have to do something that we value less highly instead. This is why the smaller a government is overall in terms of total employees, in terms of total taxes, in terms of total spending, and in terms of regulatory power, the wealthier the economy is. Now, it is true that the amount of deregulation and spending cuts and tax cuts that are currently in place are absolutely nowhere near what was being promised by the current administration on the campaign trail. Many people say, just wait, these things take time, but we've already seen backpedaling on a lot of things, talking about a $2 trillion cut in spending, going down to a $1 trillion cut in spending, going down to a $160 billion cut in spending from the Department of Governmental Efficiency. We've already seen backpedaling, talking about shrinking the military's budget to now expanding the military's budget. Don't get me wrong, any surgical removal of a tumor off of a body is good. But don't pretend like what has been done so far is a huge deal. Nothing that has been done so far is going to do anything to slow down the growth of the deficit, the growth of the debt, the runaway interest costs on that debt, and therefore the subsequent printing and higher rates for everybody else. It's going to take much, much more than slashing a few software programs with licenses for a few more people than we actually have in these departments. But what about markets? Initially, the stock market dropped in pre-market trading as soon as the decline in GDP information hit the news. The market digested that information as being negative for the stock market, starting to price in the odds of a recession. But as you can see, as the day went on and the market digested that information more and more, the market recovered. And then towards the end of the day into after market hours trading, the stock market started to spike. The reason for this is because after hours, a few large companies reported earnings and they beat expectations. Zooming out, we can see that it looks like the worst has already now been priced in. And even if an official recession is confirmed in a couple of months, it is very likely that the bear market will have been already fully recovered from by then. Markets are future discounting machines, which means they're always trying to price into the present whatever outcome in the future is most likely, which means by the time the outcome is certain, the price has already gone there and passed. The NASDAQ dropped 25% from top to bottom so far, which means that this bear market is likely almost over or already done, which means if you're not taking advantage of it and buying fantastic companies at even better prices, you are going to be very sorry you didn't do that in the next couple of quarters and couple of years. And you're just gonna be holding on, hoping for another bear market and another pullback so you can take advantage of it next time. Don't let that opportunity pass. Bear markets don't come that often. If you don't know what companies you should be buying, and most importantly, what price you should be buying them at, you need my bear market investing guide. It will only be on a crazy discount until this bear market is over, which at this rate looks to be very soon here. If you don't have it yet, get it with the link in the description below. As always, thanks so much for watching. Have a great day.